If you're just starting out as an investor, it can be overwhelming trying to figure out where to begin. But fear not, because today we're going to explore how you can invest like Warren Buffett, one of the most successful investors in history. Buffett's investment strategies have proven extremely effective over the years and have helped him amass a fortune worth billions of dollars. By following his lead, you too can potentially achieve financial success and security. In this video, we'll dive deep into Buffett's investment philosophy and discuss the key principles that he follows when making investment decisions. From value investing to long-term thinking, we'll cover all the bases so that you can start investing with confidence and clarity. Not only will we explore how you can invest like Buffett, but we'll also discuss the advantages of doing so. For example, by following his approach, you may be able to identify undervalued stocks that could potentially generate significant returns over time. So, if you're ready to take your investment game to the next level and learn from one of the greatest investors of our time, then sit back, relax, and let's get started. Stocks versus real estate. For beginner investors, stocks offer several advantages over real estate. Stocks are more liquid, diversified, have higher returns over the long term, and require less upfront capital, while real estate can offer steady rental income and appreciation over time. Investing in stocks is a smarter choice for those seeking the best return on investment. Stock performance. Looking back at the last 100 years, we have seen that while stock prices may fluctuate in the short term, they tend to rise over the long term. However, 2022 has been a volatile year for many investors due to market uncertainty caused by various events such as pandemics, trade wars, or other geopolitical conflicts. In contrast, 2020 was one of the best years for stock markets. It's important not only to consider short-term performance, but also focus on long-term trends when evaluating investments. By looking at historical data from previous decades, or even centuries, can help identify patterns in market behavior, which can inform your investment strategy going forward. Choose companies over stocks. It's important to note that when it comes to investing in stocks, choosing individual companies rather than buying shares in a particular industry can help reduce risk while maximizing returns. This is because some companies perform better than others due to their competitive advantages, or moats. Understanding these moats means understanding what sets each company apart from its competitors. Additionally, when choosing companies for investment purposes, it's crucial not only to focus on financial performance, but also management quality and integrity. A company with strong leadership will be more likely to weather economic downturns than one without good management. Warren Buffett. One of the greatest investors of all time is Warren Buffett, who has built his fortune through intelligent investment strategies. One key lesson from Buffett's success is his emphasis on long-term investing based on fundamental analysis. Buffett's tips. To become successful like Warren Buffett, it is essential to follow his tips, which include value investing, which involves finding undervalued companies with strong competitive advantages, such as Apple or Microsoft. Another tip from Buffett is understanding business models before making any investment decisions. In addition to these tips from Buffett himself, there are other strategies that investors should consider when building their portfolios, such as diversification across different sectors and countries, along with dollar cost averaging, DCA, investing, which involves regularly buying into investments, regardless of current market conditions. The key takeaway from his investment philosophy is that a focus on long-term value and patience can lead to significant returns over time. Buffett's emphasis on doing your own research and understanding the companies you invest in is also crucial. By taking the time to analyze financial statements and industry trends, investors can make informed decisions that align with their goals and risk tolerance. Another important lesson from Buffett is to not be swayed by short-term market fluctuations or popular trends. Instead, he advises investors to stay disciplined and stick to their strategy, even during times of volatility. Of course, investing like Warren Buffett is not a guaranteed path to success. It requires a deep understanding of the market, a willingness to take calculated risks, and the ability to remain patient through periods of uncertainty. Investment strategy. When it comes to creating an investment strategy like Buffett's, it's important not only to buy good quality companies at fair prices, but also focus on sectors where you have knowledge or expertise. This means conducting thorough research into industries you're interested in before making any investments. Additionally, diversifying your portfolio across different sectors can help minimize risk while maximizing returns over time. It's important not only to invest in well-established industries, but also emerging ones, since they may offer high-growth opportunities with potentially large returns for investors willing to take risks early on in new fields. Moats. In the world of investing, the term moat is often used to describe a company's competitive advantage. A moat can be thought of as a protective barrier that helps a company maintain its market position and fend off competition over the long term. In this video, we will explore what moats are and why they matter when it comes to investing. There are several types of moats that a company might have. The first type is a brand moat, which refers to the strength of a company's brand name and reputation. Brands like Coca-Cola, Nike, and Apple are all examples of companies with strong brand moats. These companies have built up a loyal customer base over time by consistently delivering high-quality products or services and marketing themselves effectively. Another type of moat is an economic moat, which refers to a company's ability to generate high profits due to factors such as economies of scale or proprietary technology. For example, Amazon has an economic moat due to its massive distribution network and sophisticated algorithms that allow it to price products competitively while still turning a profit. A third type of moat is a switching cost moat, which refers to the costs that customers would incur if they were to switch from one product or service provider to another. Companies like Microsoft and Salesforce have strong switching cost moats because their software products are deeply integrated into their customers' workflows, making it difficult for them to switch without incurring significant costs. Finally, there is also a network effect moat, which occurs when the value of a product or service increases as more people use it. Social media platforms like Facebook and LinkedIn have strong network effect moats because users derive more value from these platforms as more people join them. So why do these different types of moats matter when it comes to investing? The answer lies in the fact that companies with strong competitive advantages are often able to maintain their market position over the long term. Even in the face of increased competition or changing market conditions, this means that they are better positioned than their competitors to generate consistent profits and deliver returns for investors. In addition, companies with strong competitive advantages may also be able to invest more heavily in research and development or other growth initiatives, since they have greater financial resources at their disposal. This can help them continue innovating and staying ahead of their competitors over time. Of course, not every company has a strong competitive advantage or moat. Some companies may be highly competitive, but lack any significant barriers, preventing competitors from entering their markets. As an investor, it is important to carefully evaluate each potential investment opportunity on its own merits and consider factors such as industry dynamics, management quality, and financial performance before making an investment decision. Understanding stock ratios. To make informed investment decisions in the stock market requires knowledge of financial ratios, such as ROE, return on equity, or ROIC, return on investment capital, or ROC, return on capital. Additionally, PE, price to earnings ratio, PEG, price earnings to growth ratio, PB, price to book ratio, are also vital indicators when evaluating potential investments. These ratios allow investors to evaluate financial performance compared against industry averages, along with identifying areas where improvements could be made within a given company. Additionally, understanding how these ratios relate one another can give insight into overall health of an organization, providing valuable information about whether or not an investor should consider investing further into specific businesses. Psychology. Controlling emotions when investing is crucial, since markets tend to overact both positively and negatively, depending on current events or news headlines. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This means taking a step back from momentary trends or hype-driven deadlines before making any rash decisions about your investments. Instead, evaluating your holdings based upon sound fundamentals, rather than purely emotional reactions. Game plan. Finally, creating a game plan that includes diversifying your portfolio across different sectors while keeping an eye out for new opportunities can help minimize risk while maximizing returns over time. This means staying up to date with emerging technologies, along with monitoring global economic trends, so you're always ready to take advantage of new opportunities whenever they arise. Overall, this video serves as an excellent introduction to the world of investing and offers valuable insights into one of the most successful investors of our time. Whether you are just starting out or have been investing for years, there's much to be gained from studying Buffett's approach and incorporating his principles into your own investment strategy.